Hey everyone, thanks a lot for joining us today. This is Dawood with AutoMarketplace. So today we'll get right into it. There's an upcoming TLC public hearing next Wednesday that's going to discuss new FHV insurance, TLC insurance rule proposals, and also wheelchair accessible vehicle wait times. The focus of this article will be on insurance. It's kind of technical. We're going to try to simplify it. And so let's get right into it. So for those who who don't follow us or haven't seen some of our videos like these before, what we do is we basically draft up a newsletter article, we speak to it, we embed the video that you're seeing right now into the article, and then we'll provide links to everything we speak about. So let's get right into it. Okay. Title of the article is going to be NYC TLC stalling insurance innovation or enforcing critical rules. TLC public hearing next Wednesday, December 11th, will discuss new rules related to insurance requirements. Admitted versus non-admitted insurance debate is technical, important story to understand. So again, it's technical, but we're going to try to simplify it. So here are the bullet points. NYC TLC will hold virtual public hearing at 10 a.m. So it's a Zoom-only hearing on next Wednesday, December 11th, to discuss rules related to for-hire vehicle, abbreviated as FHV insurance requirements, and wheelchair accessible vehicle wait times. Bullet point 2, newly proposed insurance rule will impact large, often self-insured rental fleets and INSHUR, a startup in NYC's FHV commercial auto insurance market. Broader and long-term impacts of proposed insurance rules could make it less attractive for new insurers to offer products to NYC TLC drivers and fleets. So the last to our opinion. We believe large fleets that self-insure should be allowed to use not admitted carriers and create hybrid surplus coverage structures. I know it sounds super technical. We'll get into that in the article. Individual drivers and smaller fleets should only be insured by NYS DFS admitted carriers. DFS is Department of Financial Services, which regulates insurance companies in New York State, including New York City. Last bullet point, our opinion, current American Transit insolvency, which everybody knows about at this point in the industry, the largest TLC insurer with a 60% plus market share is technically insolvent. Broader TLC insurance crisis, history of industry-specific liquidations, and unique way large rental fleets manage insurance deserves regulatory flexibility that could help spur innovation. Okay. The NYC Taxi Limousine Commission, TLC, will hold a virtual public hearing at 10 a.m. next Wednesday, December 11th. The hearing will focus on, as we discussed, two things: proposed rules to update FHV insurance requirements, proposed rules to improve wait time requirements for dispatching wheelchair accessible vehicles, and reporting requirements for high volume for hire services, which is just Uber and Lyft in New York City right now. To access or participate in the hearing, please click here for instructions or see image below. In order to speak at the hearing, this is important, you should sign up no later than 5 p.m. on Tuesday, December 10th. So the hearing is on Wednesday, but if you want to speak, you should sign up by Tuesday. And then here's the cover page of the PDF that gives all the instructions. And in today's article and video, we'll focus on proposed rules related to FHV insurance. If you click these two hyperlinks, or if you go to the TLC website and email us or in the comment section if you're having a hard time finding it, there's actually two PDFs. So the information is the same in terms of how to sign up and speak and all the links to the hearing. And it'll also be on TLC's homepage on next Wednesday. By the time the hearing comes around next Wednesday, you can just go to the TLC site and they should have it on their homepage, the link to access it too. But if you want to speak, as you know, or even submit written online comments, it's important to read this. So there's actually two PDFs. So you can tell the difference at the very top. So what are we proposing? So TLC is proposing to amend its rules to update its vehicle insurance requirements. That was this PDF. And then here it says TLC is proposing to amend its rules to improve wait time requirements for dispatching wheelchair accessible vehicles by accessible vehicle dispatchers, and reporting requirements for basically Uber and Lyft. So, those are the specifics if you want to go through that in these PDFs. So we're just going to speak. So in this article, we're just going to speak about the insurance part of the hearing, not really the wait time part of the hearing. So just FYI. Okay, so what's going on? So again, this is really technical. So the whole point of making these videos and speaking to the articles and how we can help, hopefully, is obviously an insurance experts probably they might appreciate what we're saying, but sometimes these videos are for a more non trying to simplify very technical things in a non-technical way so people can participate in these hearings. So what's going on? Let's begin with TLC's statement of basis or purpose, or summary of why TLC is holding a public hearing and proposing a new, potentially clarifying FHV insurance rules. So that PDF I mentioned, this is actually contained right here, statement of basis and purpose. Okay, so here's just an excerpt from that. TLC is proposing to amend its insurance rules to better ensure coverage for TLC licensed vehicles. These amendments require more comprehensive reporting to TLC, including the mandatory submission of certain insurance policy information, such as vehicle identification numbers, VINs, and certificate of liability. These amendments also clarify that TLC's minimum coverage requirements for TLC licensed vehicles must be met through one primary policy, which will make it easier for TLC to track coverage and ensure prompt payment of claims. Additionally, TLC is updating its rules to align with the New York State Vehicle and Traffic Law and the regulations of New York State's DMV, Department of Motor Vehicles, and the New York State Department of Financial Services, DFS, which regulates insurance entities in New York State, by requiring insurers to be solvent and responsible companies authorized to do business in this state by the superintendent of insurance. The amendments proposed in this rule would provide stronger insurance carrier requirements to ensure carrier solvency, the prompt payment of claims, and the tracking of required coverage. So again, this can be found in the TLC's PDF right here. But okay. The way we would summarize the above is TLC believes its new proposals and amendments will better protect NYC TLC licensed drivers and the riding, walking, and biking public, i.e. prompt payment of claims. It plans to do this via technical rule changes that we appreciate many drivers and market participants might not immediately understand. So obviously, maybe I read that and you were like, okay, I get it. I wasn't like that. This pretty technical, very dense wording. And so we write, for example, what does the TLC mean by quote unquote minimum coverage requirements for TLC licensed vehicles must be met through one primary policy? What does that even mean? Why is the TLC stating the obvious? Quote unquote, requiring insurers to be solvent and responsible companies authorized to do business in the state by this in this state in New York State by the superintendent of insurance. So isn't that like an obvious statement? Like the insurance company should be solvent, and isn't that something that the DFS already mandates? So it's why are they stating the obvious? So sometimes it's hard to simplify a fundamentally technical topic, but we'll do our best. In addition, myself, this video over at the end of this that we'll embed in the end of this article also speaks to this article in order to help simplify and clarify what the new proposals might mean, in hopes that drivers and others can understand or actively participate in TLC's public hearing next Wednesday. Okay, so we set that up. So basically, a lot of technical stuff going on. I'm going to try to take that technical stuff, I'm going to break it down. As you can tell from this article is actually not going to be long, it's going to be dense, but I'm going to do my best to try to break down what all of these means: admitted, non-admitted, liability coverage rules, solvent, insolvent, what all of this means. And then, if you have questions, leave them in the Substack, leave them in the YouTube, and we'll go from there. Okay. So let's start out with understanding New York State. So New York State auto insurance basics. Before we get to NYC FHV TLC specific insurance requirements, you actually need to understand what coverage New York State's insurance regulator, the Department of Financial Services, it's DFS. That's what we're going to refer to that, so we don't have to say that every single time. So the DFS is what regulates all insurance in New York State, but not only auto insurance, but like health insurance and life insurance and all of that stuff. And in turn, the Department of Motor Vehicles, DMV, mandates for all vehicles that operate within the state. So again, let's begin the discussion. Just to be clear, so we're beginning the discussion by understanding, okay, what are the state requirements before we even get into TLC? So what are the state mandated limits? It's actually important to understand that, and we'll get in it Has to do with the admitted and non-admitted carrier point and what that even means. So, okay. According to DFS and DMV, the minimum amount of liability coverages for most non-commercial passenger vehicles, so just like a normal quote unquote regular car, are 25,000 per person, 50,000 per incident for bodily injury and uninsured motorists. So bodily injury could be summarized as sustained by any person in an accident. There's generally more subjective, related to pain and suffering. For example, someone gets rear-ended and they claim whiplash, now requires them to get physical therapy indefinitely and has impacted their quality of life. This may or may not be the case, but it's a subjective, meaning it's subject to opinion or analysis, matter, or hard to quantify and based on opinion. Uninsured motorists, as implied, is injuries as a result of negligent actions by an uninsured vehicle or hit and run motorist. Does not cover auto, body, or property damage. So if someone doesn't have insurance, your insurance should cover that. Very obviously, if you've seen our videos or you've followed our newsletter, there's only I think maybe 12 or 13 states in America like this. I got to double check that, but New York State is famously one of them. There's also a 50,000 no fault or personal injury protection PIP coverage requirement per accident or incident. And so this is medical expenses, lost earnings, and other reasonable. This is also called like no fault coverage. Medical expenses, lost earnings, and other reasonable necessary expenses does not cover auto, body, or property damage. Generally more objective and based on medical invoices and income history. Payouts occur quicker and regardless of which party is at fault and are meant to provide defense against delayed claim payouts as an investigation occurs before a final at-fault determination. Then there's 10,000 property damage, PD. So this is often known as bodily injuries, BI, uninsured motorists is PIP, PD. I mean, these are just acronyms that you might hear. So many people refer to the above standard auto liability policy in New York State as 25,000, 50,000, 10,000. Then maybe they'll also add a 50,000 PIP or simply 25, 50, 10. Okay. Just on the PIP thing, just to double click on that, because that's a very common thing. The concept of PIP is that, let's say, someone gets into an accident, if someone really needs, like, let's say someone needs surgery or someone needs urgent medical care, instead of them having to wait for a claims process, it's the insurance company will immediately pay out a certain amount to kind of protect against purposeful delays and stuff like that. Obviously, this can be abused with fraud, and we've talked about this as well, but that's why no fault PIP insurance exists conceptually. That's why it was created. It wasn't created to incentivize frauds. It was created as a sort of consumer protection, but obviously, like many things, sometimes a protection can be used by certain parties in a way that wasn't intended. So I just wanted to, address PIP again really quickly. Okay. Admitted insurer requirement. Okay, so what does that even mean? It is required that the above auto liability insurance coverages must be, quote unquote, issued by a company licensed by the New York State Department of Financial Services, DFS, and certified by the DMV. This is often known as an authorized insurer or admitted carrier. So, and we'll provide a links to all of these things. So this is the DFS site. So minimum auto, if you just want to, fact check us, basically, it's all here. All the minimum auto insurance requirements in New York State. This is from the DMV's site. Same thing, liability coverage. And here's what we're referring to. Your liability coverage must be New York State insurance coverage issued by a company licensed by the DFS and certified by DMV. And so getting back to this, so admitted carrier, that's what we're referring to. To be relatively simple, an admitted carrier is subject to a lot of DFS specific, New York State DFS specific oversight and rules, notably requiring the DFS's approval when it wants to increase insurance rates and requiring 3% of premiums be paid to New York State's Public Motor Vehicle Liability Security Fund, often known as the Guarantee Fund. This DFS Guarantee Fund is a sort of FDIC FDIC is like many people know that, if you put it's like a Great Depression era thing to prevent a bank run or just to get people more comfortable with the financial system. If you have bank deposits in your bank like that, that's protected up to 250,000 usually if it's an FDI insured institution. So there's actually there's insurance, kind of a FDIC for insurance, you could say, to be simple, which is called technically called the Public Motor Vehicle Liability Security Fund, but it's really referenced as the Guarantee Fund. And how that's funded, similar to probably how FDIC is funded, I have to double check that, but it's probably like the banks are paying a small percentage of deposits or something like that, and for insurers they're paying a 3% of the premiums into this guarantee fund. you know um, so this DFS guarantee fund is a sort of FDIC, as we just went over, for NY policyholders in case an insurance company fails or becomes insolvent and insurers' claims are played out. And so here's a screenshot of this public motor vehicle security fund, and here it says at a rate of 3% on direct written premiums, and is all these technicalities, but basically the insurance company is contributing 3% of their direct written premium. So to be simple, if an insurance company underwrites $100 million of insurance, they got to pay $3 million to this state guarantee fund. Okay. For example, if Geico or State Farm wants to increase car insurance premiums by 25% in New York State using an admitted carrier, including New York City, they actually need to file a request and get a rate increase improved by the DFS. It is not uncommon for the DFS to grant only partial requested rate increases. As we recently covered, TLC Insurance Giant American Transit recently got in trouble for pushing through a rate increase prematurely. What that basically means is like an insurance company, an admitted insurance carrier, and we'll get into what non-admitted is later on, but admitted insurance carrier like State Farm just can't say, you know what, the rate should be increased by 50% and then institute that the next day. Like the DFS regulates that and they say, okay, you want 50%, tell us why you want that. Then they say, okay, well, we have to balance what the consumers can afford, if that rate is justified, what it inflate, all of these things that I'm probably not qualified enough to cover all the different things that they consider. But an insurance company has to, in order to increase its rates, as an example, they have to go to the DFS, and the DFS can be sort of like a referee that balances the need for the insurance company to run a profitable business, and also as a way to protect consumers from kind of unfair rate hike increases, because insurance is kind of a scaled industry with not that many players usually. So you could argue that if it's not regulated, a sort of like cartel could form. I'm not saying that's happening, but it could form if there's only 5 or 10 major auto insurance players. They could all increase the rates, kind of thing. So there needs to be some sort of protection with that. So we actually did an article recently about an example of how the DFS kind of has protected consumers. So it's American Transit hiked rates prematurely, and so we're not going to go over the whole article, but basically what happened is there's an excerpt from something we read, I think, that summarizes it. It says, "Dear policyholder, the New York insurance law requires that increases in premium rate changes on commercial vehicles be approved by the DFS prior to being implemented. Implementation. Beginning in December 2023, American Transit Insurance Company added charge rates that were filed with but not yet approved by the department. Consequently, the rates charged by ADIC between December 16, 2023 and April 28, 2024 resulted in certain policies being overcharged. Accordingly, the DFS directed ADIC to issue credit to policyholders, and the amount of overcharges for policy issued or renewed during the said period." So that's a perfect and unfortunate example of DFS protections coming into play for admitted carriers. We'll get into non-admitted. We're almost there. I know there's a lot. Another, perhaps more troubling example is DFS. So that's one protection or oversight function the DFS has over admitted carriers. Another, perhaps more troubling example is the DFS's insurance guarantee fund, what we just talked about, that's funded by those 3%, could pay out claims if if an insurance company like American Transit is liquidated. So that's been in the news. We've been covering it. Many people have been covering it. Technically, Attic has been paying 3% of all premiums it's written since the company started operating. So its contribution to the fund should be substantial, but likely not equal to its $700 million plus deficit. We're not going to go into the whole American Transit saga, but basically, let's say American Transit was underwriting 200 or 300 million premiums per year for the last, okay, so let's say if they're doing $200 million a year on average, it's like basically they were contributing $6 million into this guarantee fund. Obviously, that's going to be well short, even if you multiply that 10 years, 15 years, 20 years, that's well short of their $700 plus million recorded deficit. But at the very least, that's the whole point why they've created the fund, just in case something goes bad insolvent, similar to why the FDIC exists. Okay, so you might be wondering why such detail is relevant to TLC's public hearing next week. Okay. So that is what an admitted carrier is. So just to be very, very simple about what an admitted carrier is. An admitted carrier is licensed by New York State's Department of Financial Services, the insurance regulator. Very notable things about admitted carriers is their rate increases and their coverages are also what coverage they provide is strictly regulated by the DFS. If they want to increase rates, they got to go through the DFS. It's not they can't simply say 20% increase and then make that happen the next day. The DFS has to approve that. The DFS often doesn't give them the whole thing. They might, if Attic wants to increase it by 30%, the DFS says like, listen, this has to be balanced. A lot of people won't be able to afford this and other considerations. So we'll approve a 12% increase. So that's one part. The other part is if you're an admitted carrier, you have to pay into this guarantee fund. If something happens to the insurance company, the claim payouts will be protected by that guarantee fund that the admitted insurer was paying into. Okay. So now we go into this use of non-admitted carrier for surplus lines. Okay, I know that sounds very technical. Again, we're going to try to simplify this. As many of our readers will know, New York City's FHVs have higher liability limits than non-commercial vehicles that operate in New York State. So we went over this, 25, 50, 10, 50 PIP. So that's the New York State DMV for general auto liability insurance. Obviously, New York City TLC regulated cars, as should be the case, is going to have higher liability limits. They're more used cars. They're transporting passengers. So those limits are 100,000 per person, 300,000 per accident, 200,000 PIP no fault. So instead of 50,000, so we don't have to go up again. Instead of 50,000, it's 200,000. Instead of 2550, it's 100, 300. So many people refer to the below standard, and you still have the 10,000 property. Many people refer to the below standard TLC policy liability as 100, 300, 200 PIP, or simply 100, 300. Sometimes they, in reference, they don't actually mention the PIP, which I think is for TLC. I think they should mention PIP, but when they talk about it, they sometimes don't. So here's some backup to that, just to make it simpler. So if this is an official New York City TLC document. So livery in black car, 100,000 per person, 300,000 per basically incident. Combined single limit, I think it's single. I think that's what CSL stands for. 200,000 PIP. For medallion tag, yellow cabs, same thing. So this is where it gets a bit quirky and leads us to what the TLC public hearing is focused on. Yes, I know this is crazy that you have to know this knowledge to understand what the actual hearing is about. Based on our discussions with several insurance industry executives and experts, the liability minimums in excess, quote unquote, surplus of the general DFS auto liability DFS requirements are technically allowed to be provided by non-admitted carriers. So we just went over admitted. Non-admitted carriers are allowed to operate under a much less restrictive regulatory regime than admitted carriers. For example, A non-admitted carrier doesn't need DFS approval to increase premiums, does not pay into DFS's guarantee fund, that 3% we spoke about, and can more easily include coverage exemptions in policies, i.e. doesn't doesn't provide coverage in certain circumstances. That's can. I'm not saying that they will do that, but they can. So just to be simple, for example, if New York State's no-fault PIP requirement for general auto liability is $50,000, one could argue the policy could be structured as followed for a TLC regulated vehicle. So the minimum requirements, sorry if I didn't clear it. So the minimum auto liability requirements has to, in our understanding, has to be provided by an admitted carrier. That can't be provided by a non-admitted carrier. So that $50,000 PIP has to be offered via an admitted carrier. You could say if there's a 200,000 PIP requirement for a TLC regulated vehicle, one could argue you could structure an insurance policy that provides 150,000 extra PIP to bridge to the 200,000 requirement via a non-admitted carrier. I hope that makes sense. Please leave a comment, etc. And if it doesn't make sense, again, this is technical. We're trying to simplify. In fact, if one takes a look at their current TLC insurance declaration page, often known as a deck page, it is likely broken out in this manner already. The only difference is large TLC insurers, Attic and Hereford, still technically offers this NYC excess line of coverage via the same admitted carrier as the NYS DFS minimums. So you can see in this kind of redacted declaration page, see this PIP? It says mandatory personal injury protection PIP. Mandatory means state mandatory. Additional PIP is actually mandatory by the TLC, but it's labeled as additional PIP. So 50 plus 150. So our point is that there, and we'll get into that, would ensure an innovative, creative, you could say whatever term you want to use, insurance product that INSHUR has created specifically for their large fleet clients, has structured a policy like admitted, non-admitted. So 50,000 is, this must be an admitted carrier. And then one could argue, the TLC might argue otherwise, that this 150,000 to bridge could be provided, that coverage could be provided by a non-admitted carrier, and there's less rules and regulations with that, which might make it easier and cheaper. It might make it easy. It might make it easier and cheaper and more accessible and preferred to have that structure for a whole host of reasons, which we'll get into. And I think it's kind of, you get where we're going with this. Like, they can increase on the non-admitted portions. They're not regulated by the DFS. So if they want to increase that by 20%, they can kind of do that the next day, sort of thing. Okay. Based on so INSHUR and large TLC rental fleets. Based on AutoMarketplace discussions, startup commercial auto insurance specialist INSHUR, which currently works. And by the way, just before we get into this, there's this link we'll provide. Yeah, there's this link we'll provide. This is a really good article we found, or not art. Well, I guess it's an article or an excerpt we found from New York State, I think barassociation.org, excess aka surplus lines. And it just very briefly, and we provide a link in the description, describes admitted and non-admitted carriers. So as an example, it says, because an excess lines insurer does not have to submit its rates and forms for approval, it can also react to changes in market more expeditiously than an authorized character admitted carrier, while an authorized insurer cannot begin to use new rates or forms until they have been approved. It just goes over like non-admitted. And then it says, contrary to what some people might think, excess lines insurers are not necessarily companies that could not meet the license requirements of a given state. Rather, they're often insurers that do not want to be licensed in order to give them the freedom to rate coverages and charge rates without the need to obtain approval of a state regulator. So this is only a couple of pages, pretty technical, but it's kind of easy to understand. So we provide a link to this, excess aka surplus lines 101, an introduction, Rona L. Platt, NSTAR US Inc. Okay. So getting back to this. So based on AutoMarketplace discussions, startup commercial auto insurance specialist INSHUR, which currently works primarily with large TLC rental fleets in our understanding, created a policy structure like we just described that uses an admitted carrier for the state mandated auto liability minimum coverage limits, i.e. 50,000 PIP, and uses a non-admitted carrier for what might be defined as excess liability limits above the DFS requirements and only required by NYC TLC. So we use that, if there's a 200,000 required PIP, you could view the 150,000. The TLC might argue otherwise, but you could argue that the 150,000 additional could be a non-admitted carrier could provide that coverage to bridge to 200,000 PIP, or there's also a BI surplus technically from the minimums in TLC insurance. So you could use a 75,000 to 250. So it was 25 to 50 for general auto. So in TLC, it's 100, 300. So that's technically 75,000 a person surplus and 250,000 an incident surplus. So you could also structure a policy like that. So we've created this kind of diagram. Again, this is created by us. We're not licensed insurance professionals, but we try to simplify what we're talking about. And it is technical, but New York State DFS general auto requirements 2550, 50 PIP. So must be New York admitted insurance companies, strict DFS oversight, rate increases, the type of coverage provided pays 3% into the DFS guarantee fund, and plus the policies have that fund covered for claim payouts. Then, okay, to bridge to the TLC requirements, what insurer it seems to have done for certain clients, and I'm probably in clients who are self-insured, which we'll get into later, there's large fleets that basically have many insurance companies within them. They have structured like admitted, non-admitted hybrid policies. So basically, insurer creates surplus line structure to bridge to minimums using non-admitted carrier. So the admitted for this requirement, and then these surpluses, 75, 250, 150, is non-admitted. And non-admitted is, less regulatory oversight, probably cheaper to operate, easier to structure creative policies. Innovate, creative can be positive or negative. Okay. Single primary policy, quote, and excess policy. So in TLC's proposed rules, it specifically states, quote, the minimum coverage required for a commission licensed vehicle must be provided by a single primary policy. Excess policies cannot be used to satisfy the commission's minimum coverage requirements. So that's actually in the proposed policy. So if we go to that, just so, and we're not, this is what we're referring to. The minimum coverage required for a commission licensed vehicle, the underline means it's a new kind of addition to the rules. For commission must be provided by a single primary policy. Excess policies, surplus policies, cannot be used to satisfy commission's minimum coverage requirements. This is what this hearing is primarily about, in our understanding. Does that make sense? Like, this is what this is addressing. Okay. The TLC is almost certainly speaking about insurers' creative policy structure, which basically meets NYC TLC requirements via two policies, one admitted, one non-admitted. Another way to view TLC's proposed rules is that the regulators simply memorialize and clarifying the intent of the original FHV insurance rules, which sought to require the use of NYS DFS admitted insurers only. So what the TLC will say is that, listen, we're actually just clarifying the rules where the minimums, it was implied. I mean, and we'll get into that. The TLC will argue that, well, we're just clarifying something. We're not changing the rules, or we're memorializing something. Okay. From our research and discussions, and this goes to this point, our research discussions happen to be proven wrong. Nothing in current DFS rules appears to prevent the use of non-admitted surplus lines to meet technically excess for state requirements auto liability minimums for New York City for hire vehicles. In fact, we have seen this, provided this evidence of NYC yellow cabs being allowed to use surplus line products, so this admitted, non-admitted structure to meet TLC requirements. Although one could argue technically TLC's newly proposed rules would seek to eliminate that as well. So maybe they're saying, yes, we shouldn't have allowed that either. That's what the TLC's retort might be. So who is this impacting? Our research combined with driver conversation indicates a large majority of individual NYC TLC drivers are insured by admitted carriers and policies from American Transit. which is technically insolvent, and Hereford, which is solvent. Therefore, so basically between those two companies, they have 80-85% plus. They're fully admitted structures. So, this situation is not directly or immediately impacting them, but you could argue, and we'll get into this as we conclude this article and video, it could impact them in kind of down the road type of thing. Therefore, impact drivers and fleets generally in the marketplace down the road. Therefore, one can assume the proposed insurance rule changes will most immediately impact large NYC TLC rental fleets and their FHV driver customers, plus passengers and public who are basically subject to claims that are in those cars while they're sitting, or something else happens and an incident is involved with those vehicles. That are insured by these hybrid admitted, non-admitted surplus line structures. Furthermore, it appears only self-insured captives used by large TLC rental companies are using these creative structures. In simple English, so basically we're saying this in simple English, well-known rental companies like American Lease, Buggy, Fast Track, and Tower, which kind of everybody knows these names, effectively manage their own mini insurance companies given the scale of their fleets and the lack of affordable admitted insurance alternatives. So what we're saying here is that the people who are using these structures are basically the large TLC rental fleets. So, and we'll get into this. You might be wondering, like, well, then who cares? We don't care about that. It's actually, there's multiple reasons to care, and we'll get into that. But that, for now, it seems like they are the only ones actually using this structure. So we believe policies backed by Accident Fund, Insure Partner, and an affirmative direct insurance company are the two major players in the NYC TLC self-insurance fleet captive space that could use hybrid admitted, non-admitted surplus line policies. Neither Accident Fund or affirmative direct actively offer a meaningful share of individual owner-operator smaller fleet TLC policies. This is from October 7th. Of note, based on AutoMarketplace analysis, Voyager Global Mobility, VGM, which owns a Buggy and Fast Track, appears to use Accident Fund Insurance Company of America, which I think is managed by INSHUR, which is part of Michigan-based AF Group. Accident Fund, to our knowledge, doesn't directly offer their TLC insurance products to individual NYC for hire drivers or smaller fleets. Our guess is VGM has created, and we've confirmed this, a self-insurance captive structure with Accident Fund, given the size of their fleet. Based on TLC's latest insurance data, there are over 14,000 active Accident Fund and affirmative direct policies. As expected, most of these policies are attached to corporations that belong to large TLC rental fleets. So, okay, so what is that captive? What does captive insurance mean? Captive insurance is a very simple concept. Basically, at its the gist of it is that you have such a large fleet that you could create your own insurance company, self-contained insurance company, and potentially manage it better, especially if there's not a lot of options in the market. So we provided a link to this, but a captive insurance company primarily insures the risk of its owners and sometimes related or affiliated firms, and returns underwriting profit and investment income. These earnings would otherwise be retained by a traditional insurance carrier. Captives are insurers owned by the insured and organized for the main purpose of funding the owner's risk that actively participate in decisions, influence its underwriting operations and investments. I know this is a lot, but fundamentally, this is a pretty technical discussion, but we're hopefully we're doing a good job trying to simplify this as much as possible. We're almost at the end of this article, by the way. Based on TLC's latest insurance, we just went over that. Okay, so these are our last few sections of the article and the video. Is this only a big fleet or TLC rental market issue? Fundamentally, the rental rates American Lease, Buggy, Fast Track, and Tower can offer are influenced by the cost of insurance. These innovative hybrid admitted and non-admitted policy structures likely, one, allows them to sustainably lower their cost of insurance, which they can pass on to their NYC driver customers, and two, allows them to access insurance outside the essentially one viable solvent option, Hereford, that might not even be willing or able to service their self-insurance captive structure. So this is our point here. We're saying that these rental companies, there's one solvent option that they can even go to, and to be fair to Hereford might not even have the capacity to take on 14,000 new policies, and if they do, the rates they have on offer or what they're willing to offer might not be sustainable, or they might actually might not even be interested in the business. So you have to layer that on. Like, what alternatives do these rental companies have, and drivers have, for that matter? If these rental companies are forced to abandon their current hybrid self-insurance captive structures that allow them to use non-admitted carriers for surplus lines, that can have negative impacts on drivers. Most obviously, the cost to rent TLC plated vehicles might increase. So the insurance cost goes up by 25%. I mean, they got to pass along at least some of that cost. We also expect public testimony in next Wednesday's hearing to address why it's not feasible for these large fleets to convince their insurance partners to create similarly structured self-insurance captives that use New York State admitted DFS carrier. So one could argue, and we just went over, like, why a retort could be like, okay, keep the self-insurance captive structure, just use an admitted carrier. There obviously has to be more to the story. We hope that's addressed by by the people. We assume that the fleets are going to testify at the public hearing, and insurance companies are going to testify at the public hearing to clarify why that's the case. Our guess, we're non-insurance experts, is that their current insurance partners, such as Accident Fund, might be more hesitant to back self-insurance captive structures if they're forced to use New York State DFS admitted entity, i.e., more expensive to operate, stricter rules, regulated rate approvals, the guarantee fund payment. Although I don't think that should be a make or break, but our point is that there has to be a technical underlying reason that we're saying that, okay, for us, it might be simple, saying like, oh, just create an admitted carrier, like easy peasy, like just create a structure where you use an admitted carrier. I think fundamentally the non-admitted structure is allowing these companies to offer the coverage in this creative manner that saves them money or helps them manage their risk or helps them find reinsurers who are willing to take on the risk because it's a non-admitted carrier. It's probably very technical, the reasons why the non-admitted surplus line structure is being used. Hopefully in the testimony, we'll get some more insight to that. Okay, TLC Insurance now includes Maya, which is kind of like a 2-ish% player. So we just want to include this. I mean, it's kind of crazy at this point, given the American transit and technical insolvency. So a New York State DFS letter, and we provide a link to this, August 9th, it says basically the examination, there's a DFS memorandum to Adrian Harris, superintendent, from James Riddick, contract examiner in charge. So the examination has determined that as of December 31st, 2019, the company was insolvent in the amount of $51 million. Its capital was impaired in the amount of $51 million, and its minimum required to maintain surplus of $2.9 million was impaired in the amount of almost $54 million. So a NYS DFS letter dated August 9th now appears to indicate Maya Insurance, MAC, which insures roughly 2,000 individual TLC drivers, they don't really insure fleets, might also technically be insolvent. This news, layered on with TLC insurance giant American Transit at its technical insolvency, essentially leaves one solvent insurer, that's Hereford, that widely offers its products to individual NYC for-hire drivers and fleets. One. The reason we are mentioning this, the reason we are saying one capital, is that this fundamentally brings us to why we're going to conclude what we're going to conclude and why our opinion is what our opinion is. This marketplace right now, the TLC insurance marketplace, has one solvent insurance company that is widely offering products. The fleet, that this admitted, non-admitted structure is not offered to individual drivers or smaller fleets. So in reality, everybody can only, we're not, obviously there's the DFS guarantee fund, there's all this stuff. So American Transit for now and Maya for now is, people should feel comfortable that these are admitted carriers, and the DFS will back the claim payouts, and so they're for now allowing them to write insurance. But it should be said that technically speaking, there is one solvent insurer that widely offers its products to individual NYC TLC drivers and fleets left in the market. So this is how we can conclude this. Allowing sustainable insurance innovation and addressing structural marketplace issues. If the NYC Taxi and FHV insurance marketplace is ultimately left with one insurance option, it is our opinion that the TLC, working with the DFS, must allow for at least some innovative insurance structures. We also appreciate, but there's another side to this, and we want to clarify that. We also appreciate allowing non-admitted carriers subject to less DFS oversight and regulations to help meet minimum NYC TLC insurance requirements via surplus lines might be controversial. Is the answer to the DFS, and this goes back decades and across several administrations, to be fair, failing to prevent the current TLC insurance crisis to allow a non-admitted American transit to arise? Is the answer to failed regulatory oversight deregulation? At least Attic Maya and a host of other insolvent, now liquidated NYC TLC focused insurance companies paid into the state's insurance guarantee fund that ensures claims are paid out, in turn protecting consumers, drivers, and consumers. Our point here is basically that, okay, you might be saying, oh, of course, that like a non-admitted, this is crazy, they're killing innovation. I mean, there's another angle to this. Like, okay, the situation with Attic is decades in the making, to be fair. So it would be very unfair. In fact, you could credit the current DFS for actually acting on something that should have been acted on before. But you could make an argument like, okay, at least Attic and potentially Maya and this history of other failed liquidated TLC insurance companies, at least there is a guarantee fund. These were admitted insurers. They were regulated. Can you imagine an Attic-like situation, but it's a non-admitted carrier that doesn't have the DFS guarantee fund to play? That would be would be a massive deal. Like that would even be a bigger deal than Attic going, an admitted carrier going solve, a monopolistic admitted insurer going insolvent is a big deal. A monopolistic non-admitted carrier going insolvent is just a gigantic deal. And if I'm understanding this right, if you're an insurance expert and I got that wrong, let me know. Okay. It should be noted, current DFS administrators seem to be taking several actions to address historical issues in the industry. Policymakers and the media also seem to be shining a meaningful light and pushing reforms that seek to address frivolous litigation that has plagued the industry, and even lowering NYC TLC's unique 200,000 no-fault PIP requirement to the state mandated 50,000 PIP minimum. Why we mentioned this is we're saying, okay, the previous DFS failed, but now there's a new day, there's a new dawn, whatever you want to call it, where the DFS is, we just saw with that Attic premature rate increase. The DFS is on this now. They're investigating Maya. They're investigating Attic. This was decades in the making. So the current DFS administration is getting involved. You got the Wall Street Journal, the New York Times, Bloomberg. They've also shown a light on Attic. They're also, talking about there's kind of this like lawsuit lending, kind of these kind of these gangs effectively are taking advantage of at least the story is that they're taking advantage of the 200,000 PIP requirement. And, remember, as we mentioned, PIP is kind of like paid out, but paid out, and it's more, quicker, because that's the whole point of PIP. It's just to reimburse people quicker. But then, they're trying to address, the establishment and regulatory figures now understand there's an issue and they're trying to address it. So should we give them time to address it, or should we just say what, we really do need some innovative solution? Okay, all things considered, this is where we come out. So as of today, this is our opinion, just to be clear. As of today, only New York State DFS admitted insurers should be allowed to offer insurance products directly to individual owner operators. So basically that 85% of individual drivers in smaller fleets, we actually think there is a fair argument that only admitted insurers should be offering products to those drivers to prevent an Attic-like situation, or where a non-admitted Attic arises, or it doesn't even have to be as large as Attic, even if 30% non-admitted player arises and then goes bust, that would be not good. So we're saying for individuals and smaller fleets, they, in our opinion, we understand the point, should not be allowed to access these hybrid structures for now. That's our opinion. We understand that point. Okay. However, a large fleet entity that has a solvent self-insurance captive, so these, like we said, they're running their own captive, backed by a highly rated character. So there's a thing called an AM Best rating, which ranks in insurance carriers by like various metrics. It's kind of like Moody's or S&P or Fitch rating, credit rating, can provide appropriate financial guarantees and quarterly financial disclosures. We think that should be allowed. Given the extremely unique circumstances and challenges that define NYC's for our vehicle insurance marketplace, the DFS can work with the TLC to come up with a unique oversight regime for such fleet captives. Finally, if these fleets self-insurance captives prove sustainable, it could eventually incentivize them and others to offer insurance products to the broader marketplace that is desperately looking for more affordable insurance options. We'll provide a summary of TLC's public hearing testimony after the 10 a.m. virtual meeting next Wednesday, December 11th. Okay. Then we'll embed this. Okay. So in conclusion, what we're saying is that we understand kind of the non-admitted, the fear about that, but we think if a large corporate entity that is honestly there, these guys don't have that many options, like these large fleet companies, they should be allowed to responsibly experiment. I mean, New York State has to be reasonable here. I mean, given the backdrop, given the insolvencies, and there's a huge history of insolvencies in the TLC insurance market. So obviously the status quo isn't working. So give these companies a chance, have oversight of it. If they're using these hybrid structures, they're still fundamentally using an admitted carrier for the state minimums. So there is an admitted carrier element of that. We just think it's very odd given the background to say like, okay, a $100 million, $200 million corporation that can provide financial guarantees, that can get like different types of insurance, that can have the infrastructure provide details to the DFS, to say that, no, we're not interested to hear that. Like, you got to use an admitted carrier. We just think that's kind of not fair, to be frank. Given the backdrop of the industry, you got American Transit insolvent, you have Maya, which is a smaller player insolvent. You have this whole history of these names, Park Insurance, Global. I mean, there's this whole history of insolvencies. In fact, one person told us that 20%, and we have to fact check this, but based on our initial research, I think this is actually true. 20% of DFS liquidations, when an insurance company basically is insolvent and then it's like wound down, this is a crazy stat, relate to NYC TLC insurers in New York State. So obviously, some innovation needs to be allowed, responsible innovation, and we think the fleets should be allowed to, who are basically running their own self-insurance captive, they should have financial guarantee requirements and things like that, but they should be allowed to do this. So that's where we're coming out, that for individuals and smaller fleets, fair enough, only admitted structures, but for those fleet captives, I think it's kind of unfair to kill that. So we hope you found this video helpful. Again, leave comments in the YouTube video or our Substack, and encourage you to participate in the hearing next Wednesday. Remember, you got to sign up by Tuesday, and we hope this article helped. I know this is very technical, and we'll see you next time.